Okay, today we're going to talk about full cost accounting. Up to now, we've learned a whole lot about successful efforts accounting, and the idea, the theory behind that was, again, we would capitalize exploratory cost if they were successful. So exploratory wells, if they were successful, were capitalized as assets. If they were dry, they were expensed under the income statement. Now we're going to learn more about full cost. We gave you the very basic definition early in the semester, an overview, but now we're going to learn a little bit more on the differences of full cost. Now remember that Swift Energy is our company that uses full cost that we're using this semester. ExxonMobil uses successful efforts. So Swift Energy, if you want to look at their statements, they use full cost accounting. Again, that's in the first note behind the financial statements. If you look under their accounting policies, you'll see that one of their policies states that they use full cost accounting. And we went over that earlier in the semester when we first looked at the basic differences. Okay, so the basics of full cost. Everything except production cost, lifting cost, OPEX, whatever you want to call it, lifting cost, production cost, OPEX, the cost of keeping a producing field going from month to month, keep it producing, everything is capitalized. That includes G&G, that includes exploratory dry holes, any successful wells, all development wells. It also includes, as we'll talk about in a later period, when we get to things like abandonment and impairments, but it also includes things like abandoned properties. For instance, if we get a property and we capitalize, of course, the signing bonus, we do some G&G, we capitalize that, we drill an exploratory well or maybe more than one exploratory well that are dry, we capitalize those, but then we kind of give up on the field. We decide it's not going to work out. So we abandon the field. The abandoned field costs are still an asset. They're still capitalized. So a full cost company relatively will have a higher level of assets. Now, if you look at Swift Energy and ExxonMobil obviously has more assets, even though they're successful efforts, because of their size, right? ExxonMobil is a much larger company than Swift Energy. If they were the same size company with the same amount of field interest and that kind of thing, and of course Swift Energy is not integrated, ExxonMobil is integrated. So for the size company they are, Swift Energy capitalizes more costs, which means generally they have more assets on their balance sheet. So all costs are capitalized except for OPEX. Now, because we've got these abandoned fields in there, though, we can no longer do DD&A on a field basis. How do I write off an abandoned field on a DD&A if it's capitalized? Because there's no production. I can't do a units of production, DD&A, on an abandoned field that's never going to produce. But full cost says I have to capitalize that field. Well, we say under U.S. GAAP, it says the cost center is now a country. Now, remember, full cost was introduced in the 1950s in the U.S. And at that time, U.S. companies really were only doing work in the U.S. I mean, they didn't have international operations. So when they said the cost center is a country, they meant the cost center is the U.S. Okay. As time went on, though, of course, U.S. companies invested more and more internationally, maybe first in Canada, but they've gone all over the world now. So in reality, the cost center, you can make a case for the international way of doing this, where internationally they say, well, the cost center is a country or a regional group of countries. And you could make that case in U.S. GAAP. So if you were in West Africa and you were in several countries in West Africa, you know, let's say Cameroon, Angola, Nigeria, Chad, you could, if you were using full cost, make a case for grouping that as a region and using that as a cost center. So the idea is if you've got a country or a region of countries as your cost center, the idea of full cost is that you're going to have some success in that region. right? If not, why are you in business, right? You're going to have some success. So if the U.S. is your cost center and your operations are in the U.S., like Swift Energy, right, you're going to have, even if you have abandoned fields, you're going to have some successful fields. That's why you're still in business. That's why Swift Energy is there, right? They're overall a successful company. Doesn't mean they're successful 100% of the time, every time they try, but they're overall a successful company operating in the U.S. Cost center would be, the U.S. Now, again, if you had some things in Canada, you could make a case for that being regionally together with the U.S. But the idea is I have some fields, hopefully many fields within the U.S. that are going to produce. So I'm going to group these abandoned fields in with those fields that are going to produce. And units of production, I'll write off all of those costs over production, over time. So all of the cost, even the abandoned costs that are capitalized as assets, will eventually get written off. So what I'm doing is I'm putting a whole bunch of assets on my books, and then I'm writing them off over time, units of production, as all the fields in that country produce. Now, International Accounting Standards, again, they don't have a comprehensive standard here. They've said they may effectively eliminate full cost in the future, but we really don't know. They haven't come out with a comprehensive standard yet. So for our purposes, this keeps falling, but for our purposes, we're going to say that under International Accounting Standards, they're basically capitalizing the same things. DD&A, again, may be a little bit different because in the U.S., all of our costs for the country are written off over proved reserves. We don't take out leasehold separately, all the costs together. Internationally, costs are written off over, and this is their wording, commercial reserves, which could be proved or proved improbable. So you're allowed to include probable reserves to write off over internationally. Now, internationally, effectively, you would have to have some differences in your assets, effectively, because of some of the asset rules internationally. In here, we're not going to get that in depth. So we're going to assume, in other words, we're not going to get quite that detailed. We're going to assume that the same costs are capitalized in the U.S. that would be capitalized internationally, and for the most part that's true, although there may be some differences in application in some companies internationally. And the only difference we're going to say we have internationally in here for our purposes is that we could use proved and probable reserves instead of just proved reserves like in the U.S. when we do our DD&A. So we don't know if internationally full costs will be eliminated in the future. We just don't know yet. So right now, full cost or some form of full cost, because I'll say some countries out there use full cost, but they kind of have their own version of full cost. So there's some different versions out there being used. So that's why I'm going to say for our purposes, we're going to say we're going to capitalize the same things internationally under international GAAP and U.S. GAAP. The only difference is the reserves in writing them off. So there are a lot of companies using full cost. I know in China there's a lot of companies using full cost, or it's not uncommon. But some of the application from country to country is different. Okay, so as we said, the cost center is now a country or a region of countries. So we're not doing this by field anymore. Of course, in your books, you're going to be keeping track of things by field, but you don't have a DD&A calculation or a DD&A account per field. All capitalized costs, including impaired and abandoned costs, are included as assets. So the next session we're going to have, actually, we're going to be talking about impairment and asset retirement obligations. So we'll talk about impairment and we'll talk about abandonment and we'll see how those work. But basically, they say if impaired properties, the impaired amount stays capitalized as an asset. Abandoned properties, the abandoned cost stays as an asset under full cost. And they're all included in the country's capitalized cost. Again, written off over proved reserves, we might include probable under International Accounting Standards if that's the company's assumption. And in here, we're going to assume that they do include probable. Now, since we're writing off over proved or proved and probable internationally, we've got to include an estimate of future development costs. So what does that mean? We've got fields in the country, possibly, that are not fully developed. So if we have fields with PUDs, proved undeveloped reserves, right? Proved undeveloped reserves, right? That means those fields are proved, but we haven't finished developing the reservoir yet. We're still drilling. The field might be producing, it might not. It doesn't matter. It's still in here because all capital costs are in here. But we still have to do some more drilling of development wells to develop all of our reserves in those fields. So what is it? This estimate of future development costs means where we have fields with PUDs, with proved undeveloped reserves, how much is it going to cost us to develop those PUDs, to make them proved developed? That's all that's in here. It's not an estimate of any other future things I'm planning to do. It's saying for all the PUDs I have in this country, in this cost center, for all those proved undeveloped reserves, how much is it going to cost me to develop those? Because my proved reserves are in the denominator. So shouldn't the cost be in the numerator, or the cost be written off over those proved reserves? So if I'm writing off over proved reserves, and some of my proved reserves are still undeveloped proved reserves, they're still PUDs, well then to get a better matching of cost to revenue, to get a better unit of production, I need to include, I've got the cost I've already spent, capitalized, but I need to include an estimate of how much is it going to cost me still to get to the rest of those proved reserves. If I've got PUDs, I've still got to do some developing to get to those proved reserves. I'm writing off over proved reserves. What is that remaining amount, or that estimated future amount that I'm going to spend to develop those PUDs? And we'll look at some examples. So here's a basic, really basic DD&A. Peters has $2,500,000 of cost to be amortized in Germany. Okay, Germany's the country. That's the book value at December 31, 2014. The fields in the country are fully developed. That just means in this example, I don't have any future development cost because all my fields are fully developed in Germany. I have no PUDs. So my future development costs are zero. All my PUDs have been developed or have no PUDs. The fields in the country are all fully developed. Production for 2014 was 25,000 barrels. And proved reserves at December 31, 2014 was 400,000 barrels. Probable reserves are using 100,000. Now, again, U.S. and internationally, if I just use proved, and in the U.S. I have to just use proved. So again, my costs can go either in the numerator or on the other side of the multiplication sign. I can substitute those in either way and get the same amount, whichever way you're more comfortable with. But my production was 25,000 barrels, so here I put production in the numerator. My proved reserves in the country at the end of the year are 400,000 barrels. Remember, just like in successful efforts, I'm going to add back production to get to my beginning of year estimate. Before I started producing this year, I must have had 425,000 in proved reserves. I produced 25,000 of those. So 25,000 over 425,000 times the 2,000,005 is 147,059. That's my DD&A. Now that DD&A, that amount will be expensed on the income statement. So that's how these costs are going to be written off over full cost. All of the costs in the country, abandoned, impaired, producing, fields that I'm exploring, all the costs that are capitalized are going to be grouped together, written off over time. That 147,059 will be expensed in the balance sheet. That's how the costs get written off eventually. But they will also, again, reduce the assets on the balance sheet through the contra asset or negative asset account called accumulated DD&A. So 147,059 expensed on the income statement, but will reduce net assets for that country on the balance sheet. Now, again, I just wanted to make a point, sorry. Internationally, I could include probable reserves in here of 100,000. And if I include probable reserves in the denominator, that's going to make that amount a little smaller, that DDA, because again, I'm writing off a little slower, including probable reserves, just like under successful efforts. And as we said, because all proved reserves are used to compute DD&A, or proved improbable, sometimes internationally, the future cost to develop those undeveloped proved reserves must be estimated and added to the capitalized cost to be amortized to get a better matching. So here's my proved reserves. If some of them are still undeveloped, how much is it going to cost me to develop them? Okay, so now we're going to come back and we're going to say Peters has the following cost in Germany at December of 2014. Proved property, $30,000. Unproved property, $50,000. G&G on proved property, $60,000. G&G, that's capitalized on property that's currently unproved, of $70,000. We have a development well on proved property. It's a development well, so it should be unproved property, or it has to be unproved property since it's a development well, $500,000. We have a well in progress on unproved property. That means it's exploratory because it's unproved property. That's $700,000. And from past years or past periods, we've got accumulated DD&A, our negative asset, of $500,000. To finish developing all of our proved reserves, we think it's going to cost another $300,000. So our proved reserves at the end of 14 are 600,000 barrels. Production for the year of 14, 100,000 barrels. And then we also have probable reserves of 200,000 barrels at the end of 14. Okay, so what are we going to do? Under U.S. GAAP, if we look at U.S. GAAP first, we're going to start here and add everything together. That includes the well in progress. A well in progress does not go into DD&A under successful efforts, but now it is. For now, you know, we've got some exceptions coming up in the future, but for right now, the basic DD&A, yeah, it's well in progress is going into our DD&A calculation. So we're going to start with the 30 and just add 30 plus 50 plus 60 plus 70 plus 500 plus 600 plus 700 minus 500 of accumulated DD&A. Once I get there, that gives me my book value of $1,510,000. That's all my assets minus accumulated DD&A. I'm going to add to that my estimate of future development costs. We're always going to use the most current estimate. Our estimate at the end of 14 is $300,000. So I'm writing off $1,810,000. Okay. So if U.S., again, I can only use proved reserves, $100,000 in production, $600,000 is proved reserves at the end of year. Add back $100,000 to get to beginning of year proved reserves. So 100 over 700,000 times $1,810,000 is $258,571. And again, internationally, companies have the option of adding probable in there, which just means they'd write off a little slower. DD&A would be a little lower. Again, that $258,571 is going to be expensed in the income statement, and it's going to reduce assets on the balance sheet because that $258,571 is going to get added to this negative asset. That's going to go up by $258,571, so that's going to reduce my assets on the balance sheet. So that will, $258,571, again, is expensed in the income statement, will reduce assets on the balance sheet. Okay, now we're going to come to the exceptions. Okay, companies have an option. This is not mandatory, it is an option. It's up to each company whether they use this option or not. And if they're in several different countries and they've got different cost centers, right, because I'm in West Africa, I'm in Europe, I'm in Asia, I'm in the U.S., I'm in South America, those are all different cost centers. I could do this on some cost centers and not others. But I have to be consistent. I can't change my mind from year to year. I'm going to do it this time in Asia, but I'm not going to do it next year. Again, I can't play with it to get my income to where I want it to be, right? I have to have a consistent policy. But there is an option to do some exclusion, mainly associated with unproved properties. Now, why would we do that? We've got, again, unproved properties. If we've got unproved properties in our cost center in this country that we're using, say the U.S., like Swift Energy. Well, we're hoping that one day those unproved properties become proved, right? I mean, that's the goal. These unproved properties one day will become proved. That would be great. That's what we're hoping for, that these unproved properties become proved. Well, if the unproved properties become proved, that's going to increase our denominator, because our denominator is proved reserves, right? So we're writing the cost off, because all costs are mixed together for the whole country. We're writing these costs off over proved reserves now, when we may add some proved reserves associated with these costs. If we've got unproved property cost in our DD&A, we may still get some more reserves in our denominator. We just haven't found them yet, right? We're still looking. So we have an option to exclude costs associated with unproved properties until we know what happens. If the property becomes proved, that's great. We add reserves in the denominator because proved reserves go up, and then all the costs will be included. If the property becomes abandoned, we can't exclude an abandoned property because we know it's never going to produce. We know reserves in the denominator are not going to change. We can't exclude those costs. They have to go in. If the property is impaired, as we'll see when we look at the impairment section, if the property is impaired, the impaired amount cannot be excluded. When we look at the impairment section, we'll look at an example and see how exactly that works. The amount that we've impaired, if we've got $100,000 in an unproved property, we've impaired $10,000. The $10,000 that we've impaired could not be excluded. The $90,000 that's not impaired could be excluded. Exploratory dry wells, if we've already drilled some dry wells, even though we haven't abandoned the field, we're still looking, but we had some exploratory dry holes, they're not excludable because we know that we're not going to get reserves from those wells. So if we have exploratory dry holes on fields that are unproved, but we haven't given up on the field, those well costs are not excludable because those wells are not going to give us reserves. They were dry. And then also excludable is the cost of a major development projects. If you've got major development projects going on that require significant future expenditures to determine proved reserve quantities in an area, then you could exclude the cost of those development projects until you've determined the reserves. Then you would have to put the cost of those projects in. Now, what we're going to look at in here is really the unproved property part because that's kind of the common exclusions that we see. So if we go back, go back for a minute to our example. We're just going to go down. What's excludable? First line, proved property, $30,000. That's not excludable. Not associated with unproved property. Unproved property is the second line. Yeah, that's excludable. That's not abandoned fields. Those are unproved properties. They may one day give us reserves. So until we know what's going to happen to those fields, we can exclude that $50,000. G&G unproved property, not excludable. Those fields are proved. G&G on fields that are still unproved, that $70,000 is excludable. Because again, that G&G might still help us find reserves. So until we know whether we find reserves or not, right, this G&G on unproved property is excludable until we know whether we find reserves. The development well, of course, that's an approved field, not excludable. The well in progress on unproved property is excludable because, again, I don't know the result. It's in progress. It's unproved property, so we know it's an exploratory well. We spent $600,000 so far. That's excludable. When I finish the well, then I'll know the result. But right now I don't. I don't know if I'm going to find reserves or not. It's in progress, so I will wait to see what happens. It is excludable until I know what happens. Once it's dry, though, it's got to be put in the calculation, or if it finds reserves, it's going to be put in the calculation along with reserves. The dry hole on unproved property is not excludable. We know we're not going to produce from that well. It's not going to give us reserves, so that's not excludable. So remember, just a second ago, our total costs were $1,810,000. I'm just going to start with that and say what's excludable. Well, the three things that we said were excludable were unproved property of $50,000, The G&G, this really just I think I called it G&G. Non-drilling exploration is the same thing as G&G. So let's just say this is G&G, an unproved property, $70,000. The same thing as non-drilling exploration costs. I'm doing exploration, looking for reserves, but I'm not drilling yet. And the well in progress on unproved property is excludable. So out of the $1,810,000, $720,000 is excludable. That's $1,090,000. So $100,000 again. So this is going to be my amount that I'm going to compute my DD&A on. My proved reserves in the denominator again, plus production of 100 to get back to beginning of the year estimate. So 100 over 700 times $1,090,000 is $155,714. I have less DD&A now, but again, at some point, all of these costs are going to come back in this calculation. That point is when I find out what happens with those fields or with that well. Once I know the fields are dry or the fields are proved, either way, if the fields are abandoned or proved, either way, these costs are coming back in. Once this well's finished, that cost is going to come back in, whether it's dry or whether it found reserves. One way or the other, it's coming back in. I'm just waiting to see, before I put the cost in fairness, we're saying, let's wait and see if we're going to add something over here to this $600,000 in proved reserves. Because that'll give me a better matching if I wait to put the cost in until I know if I've got something to add to $600,000. That's what we're hoping for, right? Then I'm doing a better matching of cost and revenue because the cost shouldn't go in until I've got the reserves. Right. Now, again, if the fields are abandoned, the costs are going to have to go in. If you have any questions on this, please let me know.